How to start investing with a low salary. The real math. You look at your paycheck, and after all the bills, you're left with, well, not a whole lot. Everyone keeps telling you to invest, but the idea of starting with just $25 or $50 a month feels almost pointless, right? It's tempting to just wait for that big raise or that better job to finally get started. But what if I told you that waiting is the single most expensive mistake you could possibly make? In the next few minutes, I'm going to show you the real, undeniable math that proves how investing a small amount from a low salary right now is way more powerful than starting 10 years from now with a much bigger income. We're going to build a simple, step-by-step plan that you can actually start today. Before we get to the plan, you have to understand the why. There are two invisible forces battling over your money: inflation and compound interest. First up is inflation. Think of it as the silent thief in your bank account. It means the cash you have just sitting there is losing its purchasing power over time. That $5 coffee you buy today, it might cost you $7 in a few years. If your savings account isn't earning an interest rate that beats inflation, and let's be honest, most don't, your money is effectively shrinking. This is exactly why just saving isn't enough. But there's a second, more powerful force you can get on your side: compound interest. Albert Einstein supposedly called it the eighth wonder of the world, and for good reason. It's when you earn returns not just on your original money, but on the returns you've already made. It creates a snowball effect that turns tiny, consistent investments into a real fortune. The secret ingredient? Time. And the more you have, the better. So, how do you put this into action? Here's a simple, no-excuses way to get in the game. First, build a good enough emergency fund. Forget the myth that you need a massive 6-month fund before you can even think about investing. That can feel impossible and just keeps you on the sidelines. The real first step is to build a small buffer, maybe $500 or $1,000. This isn't your full-blown safety net. It's your life happens fund. It covers a flat tire or a surprise medical bill so you don't have to sell your investments at a bad time or rack up credit card debt. Next, you need to get your free money. If your job offers a 401k or 303b with an employer match, this is your #1 priority, no exceptions. An employer match is the closest thing to free money you will ever get. If they match 3% of your salary and you put in 3%, you've instantly made a 100% return on your contribution. Sure, you might have to stay with the company for a vesting period to keep their part, but it's an unbeatable deal. Not taking the full match is literally turning down a pay raise. If you don't have a workplace plan or you've already gotten your full match, a Roth IRA is a fantastic tool for beginners, especially for those with a lower income. You put in money that you've already paid taxes on, and in return, it gets to grow completely tax-free. And the best part? Your withdrawals in retirement are also tax-free as long as you follow the rules, which generally means you're at least 59.5 and the account has been open for 5 years. Once you have the account, keep your investments boring and simple. You do not need to be a stock-picking genius. In fact, please don't even try. The simplest, most effective strategy is to buy a low-cost index fund or ETF. Think of it like a pre-made fruit basket. Instead of stressing about picking the single best apple or banana, you just buy the whole basket and get a little bit of everything. An S&P 500 index fund, for instance, gives you a tiny slice of 500 of the biggest U.S. companies. It's instantly diversified, and it's the exact strategy that legendary investors like Warren Buffett have recommended for most people for years. Okay, let's get to the numbers. This is where it all clicks. Let's imagine 2 people. First, we have Sarah. She starts investing at 25, putting away just $100 a month. Not a lot, right? She does this consistently for 40 years. Then there's David. He decides to wait until he's 35 when he's earning more and feels more ready. To catch up, he knows he'll have to invest more. Let's assume a pretty standard 8% average annual return. For Sarah to end up with about $349,000 by age 65, all she needs to do is invest that $100 a month. Over 40 years, her total personal investment is $48,000. Now what about David? To hit the exact same target of $349,000 by age 65, how much does he need to save? Since he only has 30 years for his money to grow, he has to invest around $240 a month. This means his total out-of-pocket investment comes to $86,400. Let that sink in. By waiting just 10 years, David has to invest almost double the amount of his own money just to end up in the same place as Sarah. You simply cannot out-earn a decade of lost time. That is the staggering cost of waiting. The fear of not having enough is what paralyzes most of us, but building wealth isn't about starting with a giant pile of cash. It's about starting a small, consistent habit. Start with $25 a month. Automate it so you don't even have to think about it. When you get a raise, bump it up a little. Let time and compounding do the heavy lifting for you. The best time to plant a tree was 20 years ago. The second best time is today. What's been your biggest roadblock or fear about investing? Drop it in the comments below. I read every single one. And if this video finally made things click for you, please give it a like and subscribe for more simple guides to building your wealth. Thanks for watching.